Every topic covered here operated in the present tense. The store card decision happens at a register in a moment with no time to, through what a low credit limit and a 28% APR actually cost the file over the next 18 months. The joint account or co-signed loan is signed at a table, in a relationship with every reason to trust and no reason yet to imagine the scenario where that trust becomes a liability. The hard inquiry from a pre-approval happens in a conversation with a loan, who never mentioned there was a softer option available, and the monitoring app on your phone shows a score that feels accurate, feels current, and may be measuring something entirely different from what the lender pull when it matters. What all of those situations share is that the damage they create is responsive. It reacts to decisions you made, products you opened, processes you initiated. The credit file absorbs what you put into it, and what you put into it can be corrected, negotiated, managed, or allowed to recover over time. But there are two categories of credit file reality that sit outside of anything you decided to do. The first is time. The length component of the scoring model is the one number that does not respond to strategy, optimization, or effort. It accumulates at its own pace and loses ground the moment a new account is opened, regardless of the reason. The second is accuracy. The information sitting in your file right now may not reflect your actual credit history, and the gap between what the bureaus are reporting and what actually happened can be larger and more correctable than most people ever discover. What comes next addresses both. One requires patience and one requires action. Either one waits for a convenient moment to become important. Store cards, strategic tool or scoring liability. The discount is the hook. You are at the register. The purchase is already in your hands, and the cashier mentions that you can save 20% today if you open a store credit card. The math feels simple. A $200 purchase becomes $160 instantly. You fill out the application, get approved in 2 minutes, save $40 and walk out, feeling like you made a smart financial move. What you actually did in those 2 minutes and what that decision costs your credit file in the months and years that follow is a calculation almost nobody makes at the register because nobody at the register has any incentive to explain to you. Store credit cards, also called retail cards, are among the easiest credit to obtain. They have lower approval thresholds than major bank cards precisely because they are designed to be opened by a broad population at the point of sale, often by people who would not qualify for a traditional unsecured credit card. That accessibility is not accidental. The retail card exists to increase spending at that specific retailer, and easier it is to get, the more consumers who can use it at checkout. The issuer accepts more risk in exchange for the captive spending relationship, and that risk tolerance translates into approval for applicants whose credit would be declined elsewhere. The first characteristic of store cards that creates a scoring problem is the credit limit. Retail cards almost universally carry lower credit limits than general purpose cards, often in the range of $300 to $1,000 for a first-time cardholder. On its own, a low credit limit is not inherently damaging. The damage emerges from the combination of a low limit and any meaningful spending activity on the card. If your store card has a $500 limit and you use that opening discount to charge $160, your utilization on that card is 32% on the day the account opens. Add another purchase or two in the same statement cycle, and you are at 50% or 60% utilization on a brand new account, which the scoring model registers as elevated per card utilization immediately. The second characteristic is the interest rate. Store cards carry some of the highest APRs in the consumer credit market, routinely ranging from 25% to 30% or higher. For a cardholder who pays the balance in full every month, the interest rate is irrelevant because no interest accrues. For a cardholder who carries even a small balance from month to month, which is statistically the more common behavior, the interest rate compounds quickly, a low credit limit, and produces a balance that grows faster than expected relative to the size of the purchases that created it. The third characteristic is the limited usability. A general-purpose Visa or MasterCard can be used anywhere in the world. A store card can typically be used only at that retailer and its affiliated brands. This narrow usability means the card serves a limited function in your life while still consuming account space in your credit file, still carrying utilization weight when balances are present, and still requiring ongoing to keep current. The value it delivers is concentrated in a single retail relationship, while the Credit file consequences are the same as any other revolving account. The case where a store card works in your favor is specific and requires the right conditions to be present simultaneously. If you are an established spender at the retailer and would make those purchases, regardless of the card, if you will pay the balance in full every single month, without exception, if your existing credit profile is strong enough that the hard inquiry and new account impact are minimal, and if the rewards or discounts delivered by the card represent genuine savings relative to your actual spending, then the store card can function as a reasonable addition to a well-managed portfolio. The problem is that those four conditions are rarely all present at the same time, and the decision at the register is almost never made with the time or information needed to verify them. The scenario most damaging to a credit file is the accumulation of multiple store cards opened across different retailers over time. Each opening generates a hard inquiry. Each new card lowers the average age of accounts. Each card with a low limit and any balance present contributes elevated per card utilization, and each card requires ongoing management to avoid the late payment that wipes out whatever benefit the discount produced in the first place. A file with 7 retail cards, each carrying a balance below the limit but paid in full, is a file dragging its score down through accumulated utilization across a collection of accounts that individually seemed harmless at the moment. Were opened. If you already have several store cards, the management decision is not necessarily to close them. Closing a credit card removes its available credit from your total, which increase overall utilization, and it removes the account from the average age calculation when it eventually ages off the file. The better approach in most cases is to use each card minimally, pay the balance full each month, and allow the accounts to age without adding new charges beyond a small periodic transaction to keep them from being closed for inactivity. The 20% discount that felt like a win at the register can be paid back many times over in interest charges, utilization damage, and score suppression that costs in lending rates than the discount ever saved. The next decision most people make without fully reading what they are agreeing to does not just affect their own credit file, it hands someone else the ability to damage it. Joint accounts and co-signing. The risks most people accept without reading people. Agree to share credit accounts and co-sign loans for the best possible reasons. A parent helping a child build a financial foundation. A spouse combining finances with a partner. A friend helping someone who cannot qualify a loan. The intention behind the agreement is almost always generosity, trust, or love. What most people do not fully understand at the moment they sign is that the agreement does not just share an account. It merges 2 credit files in a way that gives each person full exposure to the other's behavior, with no ability to control what that behavior will be after ink dries. A joint account is different from an authorized user arrangement in one, and often misunderstood way. An authorized user is added to an existing account and benefits from the account history, but the primary cardholder remains solely responsible for the debt. If the primary cardholder stops paying, the authorized user's credit file may be affected, but the legal obligation to pay belongs exclusively to the primary. A joint account holder, by contrast, is equally and fully liable for the entire debt from the moment the account is opened. There is no primary and secondary in a joint account. Both parties own the debt completely, and both credit files reflect every activity on the account with equal weight. The co-signing structure creates a nearly identical exposure through a different mechanism. When you co-sign a loan, you are not vouching for someone's character. You are legally guaranteeing the debt. The lender approved the loan in part because your credit file provided the assurance that your file's payment history and creditworthiness gave them confidence. If the primary borrower makes every payment on time for the life of the loan, file benefits modestly from the positive history. If the primary borrower misses a payment, that missed payment appears on your credit file within 30 days with the same weight it would carry if you had missed a payment on your own loan. You did not make the decision to miss that payment. You did not know it was coming. You cannot reverse it once it posts. And the damage to your file is identical to the damage on the primary borrower's file. The practical scenarios where this creates lasting damage are not rare or extreme. A co-signed auto loan for a sibling who loses their job 6 months later. A joint credit card opened with a partner whose spending habits change after a separation. A parent who co-signed a student loan for a child who defers payments without communicating that decision. Each of these situations transfers credit damage from one person's decisions to another person's file without the damaged party having any meaningful recourse other than to pay the debt themselves to stop the bleeding. The legal obligation and the credit consequence are separate from whatever informal understanding existed between the parties when the agreement was made. The exit options available after a joint account or co-signed loan is open are limited and often difficult to execute cleanly. For a joint credit card, the most straightforward resolution is paying to zero and then having one party removed from the account. If the issuer allows individual removal or closing the account entirely, closing the account eliminates the joint obligation, but also removes the credit limit from both parties' utilization calculations, potentially increasing utilization for both files simultaneously. For a co-signed loan, the primary path to releasing the co-signer is refinancing the loan in the primary borrower's name alone, which requires the primary borrower to qualify independently at the time of refinancing. If the primary borrower's credit profile has not improved sufficiently since the original loan, refinancing may not be possible, which means the co-signer legally attached to the debt until it is paid off, regardless of how the between the parties has changed. The refinancing requirement creates a particularly difficult situation in the context of divorce. When a married couple holds joint accounts or one spouse has co-signed loans for the other, the divorce decree may assign responsibility for those debts to one spouse as part of the settlement. The critical misunderstanding is that a divorce decree does not release either party from the legal obligation to the lender. The lender was not party to the divorce proceeding and is not bound by its terms. If the spouse assigned the debt in the divorce decree stops paying, the other spouse's credit file is still damaged, even if a court order says they are not responsible. The only protection from that outcome is refinancing the debt into the responsible party's name alone before the divorce is finalized, which requires cooperation from both parties at a moment when cooperation is often the scarcest resource available. The question to ask before agreeing to any joint account or co-signing arrangement is not whether you trust the other person today. The question is whether you are prepared to absorb the full financial and credit consequence of their decisions independently of that trust for the account or loan, including under circumstances you cannot currently. If the honest answer is no, the agreement is not one you should enter regardless of the relationship or the reason. What happens to both files when that relationship ends unexpectedly is exactly the next topic addresses, and the credit damage that follows is often the part of separation that takes the longest to recover from. Prequalification versus pre-approval. Why the difference costs. People points these two terms appear side by side on lender websites, in mortgage broker, in car dealership financing offices. They sound like different stages of the same process. They are used interchangeably in casual conversation by loan officers, real estate agents, and financial advisors who should know better. And because the distinction between them is never clearly explained at the moment it matters most, millions of people every year trigger hard inquiries on their credit files without realizing they did anything that would affect their score at all. By the time they understand the difference, the damage is already done and inquiry is already sitting on the file. Prequalification is an estimate. It is a preliminary assessment based on information you provide voluntarily, without the lender pulling your credit report. The lender takes your self-reported income, your self-reported debt, and a general sense of your credit range, and produces a number that approximates what you might be able to borrow if the information you provided turns out to be accurate. No hard inquiry is generated, no formal credit review takes place. The pre-qualification letter or estimate you receive is not a commitment from the lender. It is a directional indication that is subject to change once your actual credit file is reviewed. For a borrower in the early stages of exploring options, pre-qualification is an appropriate tool because it provides useful information at zero cost to the file. Pre-approval is a formal process. It involves a complete application, verification of income and employment, and hard inquiry pulled against your actual credit file at one or more bureaus. The lender reviews your real credit data, real income documentation, and real debt obligations before issuing a pre-approval letter. The result is a much more reliable indication of the loan amount and terms qualify for, because it is based on verified information rather than estimates. It is also the process that triggers the hard inquiry, the one that drops your score immediately and stays on your file for 2 years. For a borrower who is ready to make a specific purchase and needs a credible commitment from a lender, pre-approval is the appropriate step. For a borrower who is still comparing lenders or exploring options, using pre-approval before pre-qualification is a costly and entirely avoidable mistake. The confusion between the two terms is not accidental. Lenders benefit from moving applicants directly to pre-approval because it generates a formal application, creates a credit file event that initiates a lending relationship, and gives the lender access to your complete credit picture before a competitor does. A loan officer who asks for your social security number and permission to pull credit in the first conversation is initiating a pre-approval process, not a pre-qualification, regardless of what they call it. The request for your social security number is the signal. Pre-qualification does not require it. Pre-approval always does. The rate shopping window is the provision in the FICO scoring model that most borrowers are aware of but few use strategically. For mortgage, auto, and student loan applications, FICO treats multiple hard inquiries from the same loan category within a specific window of time as a inquiry for scoring purposes. The window is 45 days under FICO 8 and FICO 9. The logic behind this provision is that a consumer shopping for the best mortgage rate should not be penalized for comparing 3 lenders in a single month the way they would be penalized for opening 3 new credit cards in a single month. The behavior is different and the model attempts to reflect that difference. The practical implication is that if you are applying for a mortgage and you want to compare rates from 4 different lenders, submitting all 4 applications within the same 45-day window causes only 1 hard inquiry to count against your score rather than 4. The inquiries all appear on the file individually, but only one is factored. The score calculation. Outside that window, each additional inquiry after the first counts separately. The strategy is therefore to complete all rate shopping within the 45-day window, rather than spreading applications across multiple months, which would generate multiple scored inquiries and produce more score damage than the comparison shopping warranted. The same rate shopping provision does not apply to credit card applications. Each credit card application generates its own separately scored hard inquiry, regardless of timing, or how many applications are submitted in the same. A borrower who applies to 5 credit card issuers in the same week generates 5 separate scored inquiries, each carrying its own point cost. The rate shopping window is specifically and exclusively a loan provision, not a blanket protection against multiple inquiries of any type. The discipline required to use these distinctions correctly is straightforward. The terms are clear. Use pre-qualification for exploration and comparison. Use pre-approval only when you are ready to commit to a specific purchase and a specific lender, or when you are rate shopping within a protected window. Never provide your social security number to a lender in a conversation you intend to treat as exploratory, and confirm explicitly, in writing if possible, whether a lender's process a hard or soft inquiry before any application is submitted. The tools most people use to monitor their score are supposed to help them make better decisions. But the accuracy of those tools is a question most people have never asked, and answer changes how much you should trust what you are looking at. Credit monitoring services, what they track and what they miss. The app on your phone shows your credit score updated daily. It alerts you when something changes on your file. It gives you a breakdown of each scoring factor with a color-coded gauge showing where you stand. It feels comprehensive, it feels like oversight. It feels like the kind of tool that would catch any problem before it became serious. And in some ways it does exactly that. But there are specific categories of information that credit monitoring not track, cannot alert you to, and were never designed to cover, and the gaps in what they monitor are precisely where some of the most damaging financial events occur. Credit monitoring services operate by pulling data from one or more of the 3 major credit bureaus on a scheduled basis and alerting you when that data changes. The alerts they generate include new accounts opened in your name, new hard inquiries posted to your file, changes in account balances or payment status, new addresses or personal information added to your file, and derogatory items such as collections or public records. Those alerts are genuinely useful. A new account you did not open is a clear fraud signal. A hard inquiry you do not recognize may indicate an application submitted without your knowledge. For detecting credit file activity that involves the major bureaus, monitoring services perform a real function. The first significant gap is bureau coverage. Most free monitoring services pull data from only one bureau, and some pull from only a portion of one bureau's data. A service that monitors only your Experian file will not alert you to a fraudulent account that appears only on your TransUnion or Equifax file. Given that different lenders report to different bureaus and that fraudulent accounts can appear on any or all three files independently. Single bureau monitoring provides meaningful but incomplete protection. True three-bureau monitoring is available through several services, some free and some paid, and it closes the coverage gap that single bureau monitoring leaves open. The practical recommendation is to use a service that covers all three bureaus or to combine multiple free services that collectively cover all three. The second gap is the ChexSystems and early warning services files, which are separate from the major credit bureau files and are not monitored by any credit monitoring service operating in the consumer market. ChexSystems tracks banking behavior, specifically checking and savings account, applications, account closures, overdraft history, and returned check activity. Early warning services powers the Zelle network and is used by many banks to risk on new account applications. A negative entry in either of these systems can prevent you from opening an account at most major institutions for up to 5 years, but you will receive no alert from your credit monitoring app when it happens because these systems operate entirely outside the credit bureau infrastructure. Pulling your own ChexSystems report annually through the official disclosure process is the only way to see what those systems contain about you. The third gap is employment, tenant, and background screening reports. When an employer or landlord runs a background check, they may use a consumer reporting agency that pulls data from sources beyond the three major bureaus, including public court records, eviction databases, criminal records, sex offender registries, and identity verification databases. These checks do not appear on your standard credit file and are not monitored. Credit monitoring services. The only way to know what these reports contain is to request your own report from the specific agencies that compile them. Tenant screening companies such as CoreLogic Rental Property Solutions, separate databases that landlords use when evaluating rental applications, and a negative entry in those files can result in denials that your credit monitoring app has no visibility into. The fourth gap is the accuracy of the score the monitoring service displays. As discussed earlier in the context of FICO versus VantageScore, the score shown most free monitoring apps is a VantageScore, not the FICO score the lenders use. The monitoring service is accurately reporting the VantageScore it calculated. The problem is not inaccuracy within the service's own framework. The problem is that the score the service is tracking may move in a different direction than the score your lender will pull, and optimizing for one does not guarantee improvement in the other. Using a monitoring service without understanding which scoring model it uses, how that model differs from the one your target lender uses, creates a false sense certainty about your credit position. The fifth gap is real-time reporting. Credit monitoring services alert you when they detect a change in your file, but credit files are not updated in real time. Creditors report to bureaus on their own monthly cycle, which means a new fraudulent account opened today may not appear on your file for 30 to 60 days and may not trigger a monitoring alert until after that reporting cycle completes. A freeze on your file, as discussed in a previous topic, prevents that fraudulent account from being opened in the first place. A monitoring alert tells you after the fact. The freeze prevents the event. Both tools serve different functions, and neither one alone is a complete protective strategy. Using a credit monitoring service is better than not monitoring your file but understanding what it does not see, and filling those gaps with additional tools such as three-bureau coverage, annual ChexSystems requests, and a credit freeze during periods of non-application produces a genuinely comprehensive picture, rather than a reassuringly incomplete one. The next topic addresses a component of the credit file that most people build by accident rather than by design, and the cost of that accidental approach compounds silently over years. Credit mix, the component most people build by accident. Ask most people to their credit strategy and they will talk about paying on time and keeping their balances low. Both of those behaviors are correct and both address the two heaviest weighted components of the scoring model, but the conversation almost never touches the component that sits quietly in the background of the score, influencing the number in a way that most people have deliberately managed, have never consciously planned, and have never optimized. That component is credit mix, and the way most people arrive at whatever mix they currently have is not through strategy. It is through circumstance. Credit mix accounts for 10% of the FICO score, and it measures the diversity of credit account types present in your file. The scoring model rewards borrowers who have demonstrated the ability to manage more than one type of credit responsibly, because experience across multiple credit types provides more behavioral data for the model to evaluate than experience with single type alone. A file containing only credit cards tells the model something about how the borrower manages revolving credit. A file containing credit cards, an auto loan, and a mortgage tells the model significantly more because the borrower has demonstrated responsible behavior. Across three structurally different types of financial obligation, the two primary credit categories the model distinguishes between are revolving credit and installment credit. Revolving credit includes credit cards and lines of credit, where the available balance replenishes as payments are made and the borrower can carry a variable balance from month to month up to the credit limit. Installment credit includes mortgages, auto loans, personal loans, and student loans where the borrowed amount is fixed at origination. The payment schedule is predetermined and the balance declines in a straight line towards zero over the life of the loan. These two types behave differently, are used differently, and contribute differently to the picture of creditworthiness the scoring model is construct. A borrower with only revolving credit in their file is missing the installment component that signals they have managed a structured fixed repayment obligation over time. A borrower with only installment credit is missing the revolving component that shows they can manage an open-ended credit relationship responsibly without allowing it to become overextended. The most complete credit mix contains both types and, ideally, multiple accounts, within each type representing different relationships with different creditors. The model does not require every possible credit type to exist in the file. It rewards demonstrable diversity and penalizes the absence of it relative to a borrower in a similar scoring tier would typically carry. The problem with leaving credit mix to circumstance is that most consumers naturally accumulate primarily revolving credit in the early years of their financial lives. A credit card is the most common first credit product. A second credit card often follows. A third may follow after that. The file develops depth in the revolving category, while the installment category remains empty because installment products are typically taken on in response to a specific need, a car purchase, a home purchase, a college education, rather than a deliberate credit-building decision. By the time a borrower realizes their file is thin in the installment category, they may have years of revolving history and very little installment history, which leaves the credit mix component underperforming relative to its potential contribution. The credit builder loan, introduced in an earlier topic as a tool for building a file from nothing, also serves as a direct solution to the missing installment credit problem for borrowers at any stage of credit development. A credit builder loan held at a credit union or community bank reports as an installment account to all three bureaus, adds monthly positive payment history to the installment category, and when paid off adds a closed installment account in good standing to the file's historical record. The cost of most credit builder loans is low relative to the credit file benefit they produce, particularly for borrowers who need to add installment diversity to otherwise revolving heavy file. The self-lender product available through several fintech platforms functions on the same principle. A fixed monthly payment is made into a secured account over a defined term, typically 12 to 24 months, and each payment is reported to the E as a positive installment payment. At the end of the term, the accumulated funds are released to the borrower minus interest and fees. The credit file receives the full installment payment history from the loan, and the borrower receives the accumulated savings. The product is deliberately structured to cost less in fees than the credit file benefit it produces, which makes it one of the more defensible tools in the credit building toolkit for borrowers who need installment history without taking on consumer debt. The 10% weight of credit mix in the scoring formula means it is not the priority in a credit improvement strategy. Payment history and utilization carry far more weight and should be stabilized before credit mix is actively managed. But for a borrower who has already built a strong payment history and manages utilization responsibly and is looking for additional optimization, addressing the missing credit type in their file is the next logical step. A 10% component that is currently underperforming because of an accidental, then intentional approach to account selection is recoverable with deliberate, low-cost action. The component most people understand the least is also the one that produces the most anxiety, not because it is the most damaging when poorly managed, but because the timeline it involves is the one thing no strategy can accelerate. Every decision examined here shared the same structural flaw. The store card opened at a register in 2 minutes without understanding what a low limit and a 28% APR actually cost the file over the following year. The joint account or co-signed loan agreed to at a table in a moment of trust. Without fully reading the terms of what happens when that trust is tested, the pre-approval submitted to a lender who never mentioned that a softer option existed. The monitoring app accepted as comprehensive when it was only partial. The credit mix built by accident across years of account openings made in response to circumstances rather than strategy. What connected all of those situations is that the damage they created was a direct response to something you did, a product you opened, a process you initiated, an application you submitted, a habit you maintained. The credit file absorbed your decisions, and because those decisions were yours, they can be understood, managed, and corrected. The system can absorb a mistake. It can recover from a misjudgment. It responds to deliberate action. But there are two dimensions of the credit file that sit entirely outside of deliberate action. The first cannot be hurried, cannot be replicated by any product, and loses silently every time a new account is opened regardless of the reason. The second affects 1 in 5 Americans, often without their knowledge, and the longer it sits uncorrected, the more it costs in points suppressed, rates, and applications evaluated against information that was never accurate too. With one of them requires only patience and the discipline to stop making avoidable moves that reset the clock. The other requires nothing more than an hour, a free website, and the willingness to look at what your file actually says before a lender does it for you. Both are waiting for you right now.